Thank you for joining us today for our Capital Markets Update. My name is Kara Duckworth, and I'm the Managing Director of Client Experience at Mercer Advisors. I'm pleased to be joined today by David Krakauer, our Director of Portfolio Management. I'll be introducing him to you in just a moment. We'd like to remind you that all of the information that is presented today is of an informational nature and should not be construed as being personal investment advice. For questions about your own personal situation and the specific details, please consult your wealth advisor at Mercer Advisors. So to start today, I'm very pleased, as I mentioned, to be joined by David Krakauer. David is joining us today to provide some commentary here for us, answer a bunch of the questions, but I thought it might help to give you some information about David before we start. David joined Mercer Advisors a few years ago when his previous firm was acquired. He was the Chief Investment Officer of that firm, and he is now our Director of Portfolio Management. He holds a Chartered Financial Analyst credential, along with a Chartered Retirement Plan Specialist, and also has significant experience in alternative investments, private banking, and personal wealth management. Welcome, David.
Thank you, Kara.
We started by taking questions from all of you in advance of this broadcast, and then we'll also be taking live questions. So if you have any questions, please feel free to put them in the Q&A box. Here in the broadcast, we will answer as many of them as we can in our time together today. But rest assured, if we don't make it to all of your questions, we do record them, and we will make sure that your wealth advisor reaches out to you to answer them as well. So let's talk about some of these questions, David. I know we got a significant amount of them when we were preparing for this, and so we've put them together here in a word cloud so that you can see what the most current topics are that are on your mind. I'm sure it is no surprise to anyone that our largest word here is recession. That big one there in the middle. So let's just start there. Is a recession coming? And if it is, what should our clients do to prepare?
Well, thank you, Kara. Thank you, everyone, for joining us. I do have a few slides that I've prepared in advance to help with some of these main questions that were submitted. In regards to a recession is a period of significant declining economic activity that lasts at least a few months. And when we look at what's going on globally and in the US, what we find is that the economy and global growth is certainly slowing, but we're not currently seeing any major red flags at the moment of a potential deep recession. So if you look at this chart, this actually shows you business surveys from around the world. And the business surveys actually include things like new orders, inventories, employment, costs. So trying to get a gauge on what's going on with businesses around the world. And you can see that as of recently, towards the end of 2022, even a little bit into the beginning of the year here, we are seeing a little bit of a slowdown, and that's been pretty clear. If we look further into the United States, if we look at unemployment claims, if we look at new housing starts, if we look at just overall tighter financial conditions, again, we see a slowing in the economy. And that's one thing that we see pretty clearly. When it comes to a recession, we're putting about a 50 to 60% probability on a recession happening either sometime later this year or even early next year. But once again, we're not currently seeing any major red flags. So if we do have a recession, likely it seems like it would be a shallow one, maybe a couple quarters of negative GDP growth, but then nothing that would be a deep recession like we've seen in the recent past. So to the second part of your question, Kara, what should clients do to prepare? Really the main thing for clients to do to prepare is to sit with your financial advisor and make sure that you have sufficient liquidity, sufficient cash reserves available in your financial plan to prepare for any economic challenges that either you or your family may face. And obviously, we can't predict with certainty when a recession is going to start or end, being that pretty much all the data we receive has to do with a past condition of the markets. And when it comes to really the best thing for clients to do, it's really to sit down with your advisor, review your plan, review your risk tolerance, and make sure that you're prepared for any challenges ahead.
That's great advice. We get a lot of questions from our clients about how do you hedge potentially for a recession, and quite often those comments are about what are your thoughts on using gold or maybe other precious metals as a hedge against that?
Yeah, so it's a question that comes up often, and first off, when it comes to trying to time or trade the financial markets, it's almost nearly impossible because the stock market, for example, is always trying to price ahead of what's happening right now. So if someone were to say a recession is coming next quarter, chances are that's already reflected in the current stock values. So it's almost impossible to then go ahead and say we're going to get in or out of the market. It's very dangerous, and it's not something we would recommend doing. Furthermore, when it comes to recessions, they're actually formally announced by the National Bureau of Economic Research here in the United States. And that's a panel of academic economists. And the National Bureau of Economic Research actually has a track record of announcing recessions about 6 to 12 months after they've actually started. And then furthermore, the same 6 to 12 month lag in announcing the end of the recession. So to be able to try to time a recession is almost impossible, being that there's this big lag in information, either from specific data points or even the announcement of a recession. To take it a step further in regards to gold and precious metals, the thing that makes those types of investments a little more dangerous than even just equities is that they tend to be more volatile than the equity markets, but their periods of outperformance actually tend to be clumped together as well. So the window of opportunity to actually time that right is very small, and then combined with the fact that we have such lagging information, it makes it almost impossible to put an effective hedge into place. So again, to circle back, the main thing, the most important thing for clients to do is to sit with your advisor, make sure you reviewed your financial plan, your risk tolerance, cash, emergency reserves. It's really the best way to prepare.
That's helpful, thank you. We're also getting a lot of questions about interest rates. And can you just provide some outlook on what we see going forward with interest rates?
Sure. So in regards to our outlook on interest rates, it's heavily dependent on what the Federal Reserve does. And to provide a little bit of context, our Federal Reserve has two main policy goals that they try to achieve. One is to control price stability here in the United States, such as controlling inflation. The other goal is to promote a strong labor market. And the main tool they use in order to achieve these policy goals is actually the federal funds interest rate. And that's what this chart shows. The federal fund interest rate is actually a reference rate for overnight lending between banks. So it's a very short-term interest rate, but it underpins pretty much all of the other interest rates you see throughout our economy, underpins mortgage rates, bank rates, and almost everything in between. And what we've seen actually over the past 12 months is the Federal Reserve, in the attempt to combat and bring down inflation, has actually raised interest rates quite dramatically from 0 to near 5%. And this has actually been really one of the sharpest interest rate increases since the early 80s. And the two dotted lines you see here at the very end, the raspberry one actually shows what the market expects the Fed to do in coming months. And the market right now is expecting the Fed to cut interest rates roughly around September and start to lower them thereafter. The blue dotted line is actually what the Fed themselves is saying they think they will do. And they are actually anticipating potentially one or more interest rate hikes and rises before they tend to reverse course and start to lower them in the future. The main takeaway here is that it's not really a matter of if, but more when will the Fed look to reverse course and start to lower interest rates. So it's our belief that looking out to 2025, 2026, we're certainly going to be in a lower interest rate environment than we're seeing right now. Now, one other thing worth mentioning is there's a second tool that the Fed has in order to control interest rates or have an influence on them. And that actually is their balance sheet. So what's happening here? What the Fed has done is they actually create digital dollars and they go out into the market and they have bought bonds. And by doing this, they increase demand for bonds. And when that happens, bond issuers don't have to offer interest rates as high. So by the Fed going out and buying bonds, it tends to push down interest rates in the market. They started doing this after the great financial crisis, and then they actually ramped it up quite a bit when we had the global pandemic. So early last year, their bond balance sheet reached near $9 trillion. And so since then, what they've actually been doing is letting some of those bonds mature and just roll off the balance sheet without replacing them. So in effect, that's doing the opposite of what they initially started doing. So when they bought bonds, that's called quantitative easing. What they've been doing recently is called quantitative tightening, letting some of that demand fall off. So this actually allows interest rates to go up a little further in the markets as well. So they're raising their interest rate, federal funds rate. They're also removing some demand for bonds, which also increases interest rates. The thing to note here is that there are arguments to be made that removing this liquidity from the market is dangerous. So it's our view that the Fed will have to do this extremely gradually over time. So not something that will likely have a big swinging effect on interest rates, because they have to be careful. It may actually increase the risks of financial instability when they remove this type of liquidity from the market. And to be clear, right now, they're actually removing about 94 to 95 billion in bonds each month. And that's their quantitative tightening policy that they're conducting at the moment.
So you mentioned the Fed, and I know that a lot of people associate the Fed with banks. And banks have certainly been in the news a lot. And could you touch on what our outlook is on the banking industry in general right now?
Yeah, sure. So when we look at bank balance sheets, which we've done obviously as of late, when we look at their balance sheets, when we look at the credit lending facilities available to banks, what we find is that the industry in whole is sound and very well capitalized. But we've certainly realized a couple things in the past few months, especially with the fall of Silicon Valley Bank and Signature Bank, and even what's been happening recently still with First Republic. And what we found is when the Fed started hiking these interest rates last year, that actually brought down the value of banks' assets that they were holding. So a lot of banks hold bonds on their balance sheet. And when interest rates rise, those bond values decrease. And what we found is that a lot of banks now have a much harder time potentially covering depositors when we have things like a bank run. So if all of your depositors want their money back and your assets are now lower in value, it can create a challenge. So we have found that banks across the board, large and even regional banks, they have to some degree unrealized losses on their balance sheets from these bonds that have gone down in value. Some of the regional banks that were in trouble did a worse job managing those losses, and some of those losses were much bigger than others. But the other thing we realized is that several of the regional banks in particular really broke a very core rule when it comes to banking. And that rule is, if you're going to start a bank, you want to have a set of depositors that have diversified liquidity needs. So what does that mean? If I take in a ton of depositors' money from clients, I want it so that my clients don't all need their money back at the same time. And so what we saw from the regional banks is that instead of having broad, diversified depositor base, a lot of their deposits were clumped together in venture capitalist community, Bay Area, which made them even more prone to bank runs than a regular, more healthy, diversified bank. So those were the two main things that I think were really important takeaways from what's happening in the banking industry. But like I said, the industry in whole is very sound, well capitalized. But there are two things to keep in mind sort of stepping away from this. One is, our clients certainly should be aware of their cash balances and seeing how they can make sure their cash balances are protected, either through FDIC insurance, which covers bank accounts, or SIPC coverage, which helps cover brokerage accounts. So we highly encourage our clients to sit with your financial advisor, make sure that you understand these coverages. There are certain tools we actually have on our investment menu that can help expand some of these coverages so that you don't necessarily have to go to many different institutions and open up accounts. So for example, a CD ladder could work well in order to try to expand your FDIC coverage. The other thing that is a main takeaway is that with everything that's happened in the banking industry, there's certainly a lower confidence in our banking industry in general. Banks are now doing more to tidy up their balance sheets, and lending conditions have become tighter. So all of that equates to even more dampened outlook for GDP growth this year. It certainly has not helped our outlook in regards to economic growth in the coming quarters because of still what's going on in the banking sector.
So talking about fixed income and bonds that the banks may have had, and maybe let's expand that view out more to fixed income and the bond outlook in general. Like, what's happening with the yield curve in bonds and our outlook on fixed income in general?
Yeah. So first let me start with what is a yield curve, just so that everyone knows. A yield curve is simply plotting the interest rates of bonds of different maturities onto a graph like this. So what we're looking at here is the U.S. Treasury yield curve. And on the bottom, you'll see bonds of different maturities, all the way from 3 months to 5, 10, 20, 30-year maturity treasuries. And then their corresponding interest rates, or yields, we'll call them. So if we look at the black line here, this was from the end of 2021. And that's when the Fed had their target rate at 0, all the way at the very bottom. And to invest into bonds of further out maturities, you actually were compensated a higher annualized rate. We would say this is normal. This is a normal upward sloping yield curve. Investors are getting compensated higher rates for taking on longer dated bonds and lending out their money for longer periods of time. Now, if we jump to the raspberry line at the top here, that's actually the end of 2022. And what we can see is that it directly shows the interest rate hikes that the Fed did. But then we also see that interest rates for bonds of all maturities went up in value. And what we start to see is a little bit of a downward slope. If we move to the most recent line here on April 21st, I'll call it the lavender line, that actually reflects the additional interest rate rises that the Fed did this year. But as you can see, longer dated bonds actually are yielding even less now. And so this is what's called an inverted yield curve, when going out and buying longer dated bonds is actually providing you a lower annualized rate of return, a lower yield. And so what we've been doing in our portfolios since the beginning of last year is actually targeting fixed income instruments that are shorter in term, that have shorter maturities. And that's because we find that we're not being adequately compensated to go out further on the yield curve because we're actually getting lower annualized rates. And so that actually has worked out quite well, relatively speaking, for the performance of our fixed income portfolios last year. And we continue to maintain that stance of trying to invest more in shorter term securities, and especially since we're still being told by the Fed that they may further increase interest rates.
So talking about increases, what about inflation? I'm sure all of us have realized, head to the grocery store, buy those eggs. Inflation is definitely a part of our economic conversation now. So can you comment on that a bit?
Yeah, sure. So I do have a slide here that shows monthly inflation and some of the categories that makes up the headline number. Now, important to note, it really looks like inflation peaked pretty clearly in June of last year. And since June, we've actually had 9 consecutive months of lower headline inflation. March isn't on here, but March actually came in at 5%. And so we're certainly seeing some of the effects now from the Fed increasing their interest rates and tightening financial conditions. What that does is lowers demand for goods and tends to bring down prices of things in the economy. And what you've seen actually over the past 12 months is you actually seen some of these categories change quite a bit. So for example, energy prices, even with the war in Ukraine still going on, it used to be a big driver of headline inflation. Energy prices have actually come down quite a bit in regards to their contribution to the headline number. And this sort of shows us that even sometimes the things that seem most obvious can actually go a different direction. And if we looked at something like used vehicles, vehicles used to be a strong contributor also to headline inflation. In the most recent March month, they've actually gone down in value, so deflator, and they've actually been helping now to bring down the headline number as well. So it seems that things are going in the right direction. What's important to note, though, is that the Fed's target for inflation, so what the Fed's been trying to do with higher interest rates to bring down inflation, they're targeting about 2.5%. And so even with the March numbers at 5%, it still looks like we are a little bit away from their target. And I think that has been the contributing force into why they may continue to do another rate hike. One last thing worth noting here, just like with some of the metrics on the economy and economic activity, a lot of these numbers are backwards looking. So there's a lot on this graph. This is a heat map of month-over-month inflation. So as recent of data as we can get. And one of the things I wanted to point out is that one of the most recent drivers of inflation actually comes down here when it comes to shelter costs. And if we look at what makes up shelter costs, we actually find that it's not what many people may think. There's something called OER, owner equivalence rent, which makes up a big piece of shelter costs. And that's actually a non-cash expense. It's an estimate of what people that own properties would likely be paying in rent. So even though we see this as a big contributor to the headline number, the point here is that when you dig into the details, what you are experiencing when it comes to inflation may be very different than some of these numbers you're seeing either in the media or being reported through CPI. So in regards to inflation, we see it going in the right direction. It's coming down. But there is some underlying stickiness in some of the core numbers. I think that's going to potentially make the Fed raise interest rates again to further fight it.
I think you make a great point about it depends on what affects you directly. If you're not in the market for a used or a new car, the inflation of whatever that is, or as it's gone back down, doesn't really affect you. So even though you hear reports on the core CPI number, your personal experienced inflation number may be different, and it's worth thinking about that.
Yeah.
So I'm going here to our live questions here, David, and we've got questions here, quite a number of them, about the debt ceiling. Should we be concerned about the debt ceiling and its effect on markets?
Yeah, it's a fair question, and just to be clear, the debt ceiling, raising the debt ceiling, that doesn't authorize new spending. What the debt ceiling does is it allows us to pay the obligations that we've already committed to through spending that has previously been approved by Congresses and presidents from both parties. So, we certainly are optimistic that Congress will find a resolution. We're hoping it doesn't go as far as 2011 and what we saw, where we went almost all the way up to the edge. And we certainly do not like to think about the prospect of us actually defaulting on our debt and not paying our obligations. If that were to happen, there would be ripple effects throughout not just the U.S. but the global economy. The credit status of the U.S. really underpins a lot of lending and a lot of reasons for why investors and financial participants around the globe hold the U.S. dollar or even utilize some of our institutions. And so without a doubt, it's something that we're watching. And in regards to what happened in 2011, where we actually saw Congress go almost up to the last day before defaulting, it certainly can have financial implications. So the stock market sold off. It was a quick sell-off, but roughly 10-11% in 2011. It didn't take too long to rebound after the fact, but the damage was done. And when you erode that confidence in the United States government, and it can have ripple effects to the U.S. dollar, to many other areas as well. So we're optimistic, right now that hopefully a resolution is found, and I think both sides of Congress say that they really don't want to go that far. So we're hoping that it doesn't get to that. No.
Got several questions here as well on if the U.S. dollar is replaced as the world's reserve currency, what implications does that have? And maybe you should start with what is the world's reserve currency, and then talk about the U.S. dollar.
Yeah, sure. So, it's no surprise that this is coming up when it comes to the U.S. dollar. The U.S. dollar has gone down in value a little bit recently. And then there's also been a lot of headline news of other countries moving to bypass transactions with the dollar, such as China and Brazil avoiding the SWIFT system and settling trade in the yuan. And there's other things that Russia's been doing as well. But the bottom line is, when we think about the dollar's status as the world's reserve currency, really what we look to are central bank reserves around the world. So the Federal Reserve is our central bank, but there are central banks throughout the world that hold reserve currencies. And if we look at all of the reserve currencies for central banks around the world, the United States dollar makes up roughly about 60% of the reserve currency. After that, we have the euro, which makes up about 20%. And then after that, we see some other developed markets, and then I believe China, as of lately, their yuan is about 2.7% of global reserve currency. So we're still the dominant force in many ways. If we then look to foreign transactions occurring with different currencies, we actually find that around the world, 90% of foreign currency transactions involve the U.S. dollar to some degree. We also find that if we look at foreign debt being issued, either in developed or emerging markets, a large majority of them still actually issue debt denominated in U.S. dollars. And then lastly, if we look at the commodities markets, most major commodities are actually priced in U.S. dollars. And so the U.S. dollar is extremely prevalent still throughout the world, and also still holds the majority of global central bank reserves. So we do see that it would have to take some time still, and some major movements which we have not seen in regards to its usage for it to be, I think, a more credible threat. But on the flip side, if you look at what we're doing here at home, if you look at the debt ceiling situation, there are things that we can do better to help ensure our status with the U.S. dollar globally. So our own fiscal responsibilities and not having unnecessary turbulence in regards to what we're doing from a government standpoint, like with the debt ceiling situation. Those things have the potential to erode confidence in regards to our image with the rest of the world. That is not a good thing longer term for the U.S. dollar. We want to keep that image of strength, stability, transparency, rule of law. That's what really benefits us in the long run.
So you mentioned international markets, international investing. Mm-hmm. Thinking about our Mercer Advisors portfolios, we have allocations to international equities, international fixed income. Mm-hmm. So can you talk about why we hold them and what our view is on international as an asset class?
Sure. Just to back up a little bit, if we look at global equity markets, we actually find that international equities make up about 40% of global equity markets. And within our portfolios, we don't have that much exposure. We are more overweight United States equity markets, but we do have some exposure to international equities, and we find that it's very important. One is the value of diversification, not just over a couple hundred stocks, but actually over several thousand stocks, is extremely important to capturing long-term equity market returns. And by doing that, you're actually minimizing company-specific risks. We call that idiosyncratic risks. And we're also minimizing the potential for country-specific risks as well. So imagine some sweeping legislation were to occur here in the United States. That would primarily affect probably our equity markets more so than overseas, depending on what it is. But furthermore, if we look at international equities, they're actually trading at a very significant discount compared to U.S. equities. So we often get the question of, well, there's a lot of geopolitical uncertainty, there's a lot of things going on internationally, and that's correct. So you have to be smart about what you're investing in the international space. But if we actually look at values, there's about a 30% discount off of international equities compared to the valuations that we're seeing here out of U.S. equities. So a lot of those additional risks and some of the country-specific risks are actually being priced in and are actually pretty attractive when it comes to long-term investing. So there are several reasons why we believe it's also very important to have that international exposure to some degree. And the last thing I'll mention too is that in regards to the U.S. dollar, for any clients that have fears or worries about the U.S. dollar, longer term going down in value, one of the best ways to offset that is to have some international equity exposure. So if you actually own companies in Europe or Asia that are having their revenues, come in the euro, for example, if the dollar is going down in value, then when those revenues are translated back to you here in the U.S., they're actually worth more. And so we've actually seen this over the past 6 months. So the past 6 months, we've seen the dollar actually decrease in value. And we've actually seen that international equity portion of many people's allocations outperform by close to 14%. So if we're looking at hedging different risks, country-specific risks, if we're looking at trying to capture long-term returns, it's really important that we maintain that allocation to international. And we've seen large periods of time where international has really been the bellwether for the portfolios. Most recent example is the early 2000s. From 2000 to 2010, U.S. stock market was flat. International markets really helped drive performance during that period of time. So it's something that we maintain, but compared to the overall global equity market, we're actually a little bit underweight compared to what the global market would suggest.
So going through here more of the questions that people are sending in. Feel free to put them in the Q&A as a reminder if you've got questions for us. But let's dive into another question about asset class, asset allocation. And the question is, how do we think about ESG investing? And maybe talk about what is ESG investing to start with, and then your thoughts on that.
Yeah, so ESG investing is when you're looking to align your investments with environmental, social, or governance values and preferences. And to step back a little bit, it's important, I think, to talk about what we at Mercer Advisors believe. And what we believe is that clients deserve transparency and also the freedom to align their portfolios with their values, whatever they may be. So, for example, we have capabilities in our investment menu to align clients with their religious values and beliefs. We have faith-based portfolios. In addition to that, we have portfolios that align clients maybe with environmental goals or goals having to do with things with the climate. So we are looking more so for the ability to have transparency for our clients so that clients can feel assured that nothing that they're investing in is going truly against what they believe or what they want. And that's a capability that we think is very important for our clients. It's also worth noting, though, that if our clients, for example, say they have no preferences, then what we do by default in our core programs is not implement some of those different types of values. We actually are strictly looking at academic, research-based ways of investing. So whether it's our multi-factor program, which really puts to work our best thinking from an academic standpoint on long-term returns, that's what we are focused on in a very objective way. But having the ability to then scope the portfolio based off of what our clients may want, we think is very important.
That's great context.
Yeah.
Now we've got a lot of questions coming in here on strategy that we're going to change to. So first is just about, you commented about interest rates and a bit about the correlation here to mortgage rates. And are they tied together? Are your thoughts that mortgage rates could go up? Questions are related to and does that affect perhaps housing starts as well? Yeah,
sure. So first off, housing starts we're starting to see slow down a little bit. And certainly the rise of interest rates has an effect on that for anyone looking to get financing to either build or anyone looking to get financing to buy a home. So in regards to what the Fed funds rate does, remember the Fed funds rate, that's the overnight reference rate for bank lending. That truly underpins many areas of the market. And it does have a correlation with interest rates such as mortgage rates, but it's not a direct relationship by any means. So if the Fed increases interest rates, as an example, another 1/4%, that doesn't necessarily mean that mortgage rates are going to go up 1/4%. So there's a lot of calculations that go into that. So banks or lending companies, they have their spreads that they try to make in regards to their profits and their own balance sheet situation. But then longer dated interest rates also take into consideration inflation expectations and growth expectations. And that's why year to date, you've actually seen some of those longer dated interest rates actually come down a little bit because the expectations for inflation and growth have actually been coming down. So the Fed raising rates or lowering rates, that has an effect. It's at the baseline, but then there are adjustments made. So you can't easily predict what's actually going to happen with something like mortgage rates if the Fed decides to do another rate hike or not.
Terrific. Hopefully that was helpful for those of you that put in those questions. Talking about interest rates, bonds, how all those work, we've got a question just on what is the place of bonds in a portfolio? And if you were just starting out, let's say right now, what would you be focusing on as a bond investor?
Well, so first off, if we're assuming that a bond allocation or a fixed income allocation is the right move for you, that's where I would then look to what we discussed earlier about trying to focus on bonds and fixed income instruments that are shorter in duration and have less interest rate sensitivity based off of how they're structured. In regards to whether bonds are the right move for you, though, I would actually flip that back to you, Kara. As a financial planner and advisor, how would you then go about that assessment?
I would think really what you're looking to as working through your own personal situation is what are your income needs? What is it that you're trying to solve for in your portfolio? If you're in retirement, I would say maybe you consider putting bonds into your portfolio because you probably have some lifestyle expenses that you need to support. If you're younger and still in an accumulation phase, you may want to consider less of bond allocation in your portfolio because you'd like to have growth over time. So really depends on what your personal situation is, but I would agree with you that certainly right now, if that is appropriate for your situation, that you want to be looking on the shorter term. But they're an important part of a portfolio for people to make sure that they're considering on a diversified basis. Yeah. Well, while we're talking about strategy, David, we've got a whole bunch of questions here about that. So I'm going to kind of group them together here, everybody, for to answer here. But we're talking about taking into all the things that you've mentioned. There's potential for a recession. We've got inflation. Interest rates might be going up. What advice would you give to people thinking about should they be changing out of their stock positions and maybe thinking about CDs at a bank or some kind of other investment? Should you change your portfolio allocation in response to that? What kind of advice would you give someone in those situations?
So first off, what I would say is, whether you're holding equities or cash instruments or things like CDs, that's very much a financial planning question. So I would certainly encourage everyone first to discuss with their financial advisor. In regards to trying to time the market, time the equity market specifically, really all of the data shows that it's almost impossible to do that. And when you try to do that, what ends up happening most often is you end up missing out on the period of time when stocks are recovering in value. So remember what I said earlier in regards to equity markets always trying to price in the future. So they're always thinking ahead. If there's a probability of any risks, they're usually already baked into equity market valuations. And what I would say based off of what we're seeing right now in the market is that earnings estimates have come down a little bit from the beginning of the year, and so we've seen U.S. equity values go up slightly, but we're still not in any kind of period where we're seeing broad overvaluations in the equity markets. So I wouldn't be suggesting any kind of timing efforts or anything like that in regards to getting in or out of stocks. What I would point out actually is that there is activity happening constantly in our portfolio. So there's really several different areas of activity. There is the most basic account level where we are proactively rebalancing our clients' accounts, often on a quarterly basis. So if the stock market either runs up or sells off, there's a potential for trading to then happen to sort of balance out our clients' risks and keep them in alignment with their long-term goals. But then also within many of the strategies we use, there's daily activity happening within those strategies, such as reallocating to stocks of more attractive valuations or looking at stocks that have core stable earnings with reliable profitability. So there's things that are happening within a lot of these strategies every single day even. And then lastly, when we think about what our investment committee actually spends a good amount of time on, some of those bigger strategic changes. Even recently, we've had a few updates where we are moving different strategies in and out of our portfolios based off of some of the academic science showing more attractive outlook for returns with different strategies. So there are things that we're doing pretty consistently at different levels for reallocating and also tweaking exposure for our clients. But I would highly caution clients against any kind of in and out of the market in general. Like I said before, what that ends up doing most often is eroding returns, because a lot of clients then miss out on the recovery period if there is any major volatility in the stock market.
I would add, from my perspective as a wealth advisor, if it is appropriate for a change in your allocation, and you do have perhaps a lot of unrealized capital gains that you have in your portfolio, if you've had long-term positions that you've been holding, working through your particular potential cash and your target returns for your financial plan to work, there are things that you can do. Think about perhaps a capital gains budget every year that your tax situation might be able to withstand if that's really important to you. There are also things to think about on asset location. If you've got the ability for, you've got perhaps an individual retirement account that you can make changes to that allocation in your portfolio as a whole without tax consequence. These are the things that, again, it's so important to talk with your advisor on your strategy for your portfolio, but recognizing that your financial plan is what drives your portfolio allocation, not the other way around. So I would really encourage you to do that. So we've got tons of great questions still here coming in, David. So more along the lines of asset allocation, and I know that you've got experience here. So what are your thoughts on alts, private equity, credit in a portfolio?
So great question. So the question is in regards to alternative investments. And just to give a little context, what that often means is investments that aren't daily liquid, where you can't specifically sell them and get your money back right away like you can with, say, a publicly traded stock. So illiquid alternative investments like private equity, private credit, private real estate, they only make sense really for certain types of clients. And I highly encourage you to talk with your financial advisor first to see if they're actually appropriate for you and your situation. For many clients, they're actually not necessary for meeting your long-term financial goals, but in regards to allocating to them, they can make sense depending on your overall situation. And I would suggest that you talk with your financial advisor. And then, Kara, I'd be curious actually to see how you would respond to that for your clients as well.
So I would say, again, it's really, really client specific. Can your portfolio appropriately have an allocation to investments that aren't liquid? Do you have other sources of income if you needed to do that? And for some clients, that is very appropriate, and they understand the risks involved in that and do need that diversification. I think it's also really important, again, talking about your whole entire financial plan. Look at what other holdings you have. Do you already own a lot of real estate or other investments outside of just your brokerage accounts that need to be considered when you're looking at your overall asset allocation? As we always talk about, diversification is what is the most critical thing in your portfolio. So certainly worth having that conversation, but recognize that that's really personal based on what your situation is. So we've got a few other questions, and again, people coming in and asking about gold and silver and precious metals. So maybe just kind of talk about, again, does that have a place in a portfolio? We talked about it as a hedge, but maybe just as an asset class.
Yeah, so gold, silver, precious metals, commodities, we find that, again, they tend to be very volatile, even more so than regular equity markets. So we actually don't implement them in our standard models in any direct way. There is some exposure to raw materials, in the S&P 500, for example. So there are some very small pieces of our core allocations that do have some exposure there, but we're not going out and necessarily buying or selling gold within our portfolios. Similar to something like cryptocurrencies, things along those lines, where we're seeing investments have a high degree of volatility and not necessarily any revenues or cash flows sort of backing a specific valuation. That's where we tend to put them into the more speculative camp. So we can even sort of look at the recent past here with some tech companies where they have no cash flows at all, but they have been having these very high valuations. Those also can be very speculative. So we generally don't look to them as core pieces to any of our portfolios. But again, based on your specific situation, in talking with your financial advisor, there could be small allocations that you may feel comfortable with, and your advisor may feel comfortable with working into your financial plan. That's something that, again, I would encourage you to speak with them about.
So on the other end of talking about potentially illiquid investments, we've got a question about money market funds. Mm-hmm. The particular question is just kind of about protection, and are those considered like bank account, or is that separate?
Yeah. So the question about money market accounts. So money market accounts you have in your brokerage accounts. And your brokerage accounts actually are covered by SIPC insurance. And the basic coverage limits is up to $500,000 can be covered for each account and each entity owning that account for securities and also for cash. So SIPC is brokerage, FDIC insurance, that's your bank account. And there's things that you can actually do through your brokerage accounts to actually allocate to bank CDs. And that's something that I mentioned earlier that we've been doing for clients when it comes to trying to actually get that FDIC exposure without going to all the banks in town and opening up different accounts. So this is something that can get a little complicated depending on your ownership structure for accounts. So if you're husband and wife on one account, and then husband and wife have their own individual accounts, IRAs, trust accounts, these coverages can expand, and you want to make sure you sit down with your advisor to have a good grasp of what is and isn't covered. But money markets, as an example, those are securities, and they are actually covered under your brokerage accounts under SIPC insurance.
That's very helpful. Thank you. We've got a question about bonds. We've talked about kind of the short-term nature of them. What would you be investing in if you were just starting out here? But we have a question about are there alternatives to think about to bonds in a portfolio? Maybe you can talk about asset classes and how would you diversify?
Yeah, so the thing that makes bonds unique and very traditional in regards to managing risk in a portfolio is that over time they tend to be a ballast for your equity exposure. When equities go down, historically bond markets go up and vice versa. And they tend to be much less volatile than equities as well. So I wouldn't necessarily say there's anything that could replace them. There are other asset classes. There are other bank type products or cash products that are also safe. But what bonds tend to do is they can provide some of that upward movement if the equity markets sell off. And then in regards to illiquid investments like private credit, for example, those tend to be more like higher risk bond allocations. So think high yield credit. So that's more equity-like in nature, not necessarily something I would ever consider replacing your core bond allocation with. So hopefully that answers the question, but I wouldn't say that there's really a replacement for bonds. If it makes sense for your long-term goals in your portfolio, then that's really the way to go to help offset some of that equity risk.
Sounds like really, again, just going back to talk with your advisor, look at what your allocations are to cash, to money markets, to bonds, to really any of the things that we've been talking about today, whether it's alternatives or equities or international, looking through what your whole portfolio is and all of your assets in your financial plan to look at your overall allocation. So as we're wrapping up here, David, I'm going to give you the $1 million question. What is it that you worry about?
Is it that I worry about?
What is it that you worry about?
What I worry about is mostly clients doing things that are against their best interest. That's really what I worry about most. I know even with dealing with my own money and my family's money, a lot of emotions can come up very easily, especially with everything you see on the news and headlines. So, what I worry about is clients, doing things that are against the best interest of their financial plan, which is why so often you hear us say how important it is to talk with your financial advisor. And, one of the most valuable aspects to that is it really slows down the decision-making process. And when you slow down the decision-making process and you include your financial advisor, what you find is that you're less prone to making any kind of rash decisions or mistakes that could erode your long-term performance. And so a recent study actually just came out comparing actual investor returns to the stock market index returns. And the study actually shows that most investors are drastically underperforming just the index. And a lot of that has to do with their own decision making on trying to either time the market or move investments around. And that's why one of our core tenets is truly looking long term and thinking long term with your investments, not trying to time the market, making those strategic allocations and holding them. That's the recipe for success.
I definitely agree with that. Yeah. So we realize that you have submitted other questions. We're running up here on time. We have recorded all of the questions that you have, and we will ask your advisor to follow up with you so that you can get an answer to your specific questions or questions that may be about your own personal situation or strategy. But we also want to let you know that this broadcast has been recorded, and we will be posting it to our website, merceradvisors.com. You'll want to look under the Insights tab, and you will find that listed. It'll take about 3 business days for it to be posted, but it will be there, along with other articles and insights from our entire investment committee about economic news, financial planning topics that you can find helpful. So as we wrap up here, David, thank you for joining us.
Thank you. Thank you, everybody.
Thank you to all of our clients for joining us. And again, feel free to reach out to your wealth advisor, look on our website for additional information that you may have. Thank you for joining us.